Hey everyone, welcome to Fast Pass University, where we make passing your insurance exam simple, clear, and stress free. So glad you're here. Whether you're studying for life and health, property and casualty, or personal lines, this channel is all about helping you understand the material, not just memorizing it. Here you will find state law lessons, exam walkthroughs, study strategies that actually make sense, all of that good stuff. But before you dive in, please make sure to check out our website at fastpassuniversity.co. That is .co. Where you can download study guides, workbooks, other resources to follow along with these videos. And if you want live help, tutoring, or studying alongside other students, join our FastPass community on School at school.com/FastPassUniversity. It's our private hub for live classes, instructor support, and a place to ask questions anytime. I'm so excited to help you start your insurance journey. Let's get you your Fast Pass. Hey everyone, welcome back to the channel. Today we are going to dive into one of the most important and honestly one of the most misunderstood parts of your insurance licensing journey, one of the more difficult areas on the exam, and that is state laws and regulations, right? So these are going to be items that you're going to need to know and need to look up specific for your state, specific to your exam content outline. And you can hop on one of our videos as well. We are in the process of dropping videos for all of the state law regulations for all 50 states and Washington, D.C., depending on when you are watching this. You can take a look and see if we have dropped your state yet. If we have not, please leave a comment with your state and exam. We're working on getting these all out for you. However, if yours is not out yet, that's all right. Or even if it is and you want some extra practice, these videos are going to be very, very helpful to you because we are going to focus on the parts that every state tests on, right? Now, while every state may have their own numbers or timelines, penalties, things like that, I will go over the most common, but it is crucial that you find out your state specific ones. But this way, when you are diving into your state law and regulation sections, you know what to look for, what to highlight, what's the most important, right? Because this can be a rather boring and rather challenging section when you're studying. Okay. So I am going to break it down for you, tell you what to look for, and help you understand the concepts. We are going to start with state laws and regulations that are common to all lines across the board. And then, depending on which exam you are taking, whether it's life and health, annuity, or property and casualty, those will be split off into whatever recording you are watching. All right. So let's jump in. All right. So, how state regulation works. Every state has a Department of Insurance, and there is somebody that is either elected or appointed by the governor to kind of head the department. Okay. And depending on what state you're in, that person may be titled something a little different. So, most common, we're going to see commissioner, director, or superintendent. There are some states that call it something different. Chief officer, we'll see down here. That is for Florida, actually. So it is important to know what this person is called for your state, right? Because you could see a question as simple as our example question down here. Which official typically enforces insurance laws within a state? Secretary of State, Attorney General, Insurance Commissioner, Director, Superintendent, or State Treasurer? The correct answer here is obviously C. Now, it will not give you all of these. It's going to give you the option of just what that person is titled in your state. So it's important to know what that title is. Also, you're going to see that term used frequently as we dive more into what the commissioner or director or superintendent does. So it's important to know what that term is when we're looking at these things and diving into them so that you're comfortable and can connect the dots. Now, I am not going to say commissioner, director, superintendent, chief officer every time I'm talking about this person. I may say commissioner or superintendent, etc. So just know who that is that I'm talking about and know what that term is for your state. So while the title may change depending on what state you're in, the core responsibilities are universal. They stay the same. Okay? So the commissioner or director, etc., has the right to enforce state insurance laws. Okay, so if an insurer or an agent are breaking any rules, which we'll go over some of those in more detail, the commissioner or director or superintendent is the one that's going to step in, right? They can send cease and desist orders. They can, down here, we're going to jump a couple bullet points, conduct investigations and hearings. They need to look at your records or, actually call a hearing to figure out what's going on. And if the person is, found guilty of violating any insurance laws, they can impose fines or disciplinary actions, okay? Revoking licenses, suspending licenses, and such, okay? They can also approve forms and rates. Approve, right? If an insurance company wants to raise their rates, right? They can't just the State Department of Insurance with the commissioner or superintendent, director, etc. And then they can approve them or deny them, etc. What they do not do is set insurance rates. Okay, they love to ask this question. The commissioner can do all of the following except, and they'll list some of these bullet points that I said, and then they'll usually throw in set insurance rates. That will be the incorrect answer. Okay, the commissioner does not set insurance rates. They approve or deny them. Love to see that question. So make sure you are comfortable with what the core responsibilities are. So when they throw in that other one, like set insurance rates or something else that they throw in there to try to trip you up, that you are solid in what the commissioner can do. So diving a little bit further into the duties of commissioner, director, superintendent, such, understanding the role of your state's chief insurance regulator is fundamental to life insurance and annuity practice. Now, this should just say all insurance exams, okay? The title varies by state, but the core responsibilities are universal. Pay attention to enforcement powers and regulatory authority. These are frequently tested. So again, the commissioner, director, superintendent, chief officer, they regulate insurance through states regulate insurance through this person, right? Commissioner, director, superintendent. You must confirm what that person is called in your own state. Check your insurance outline. It's going to say it right there. It'll say duties of the commissioner or duties of the superintendent right in your state outline. However, you do want to be looking over these, finding out your exact numbers, timelines, penalties, etc. If you don't have a course yet, you can grab one through our website or check out our state-specific videos. If we don't have yours up yet, comment your state and exam below. We are working on getting these out for all 50 states and Washington, D.C. All right, so universal responsibilities, as we said on that last slide, and you need to be comfortable with these. You need to know these. They enforce state insurance laws, approve forms and rates. They do not set the insurance rates, but they approve or deny them. They issue licenses. Once you pass your exam, the person that's going to issue your license is your director or superintendent. They conduct investigations and hearings as needed, and they impose fines or disciplinary actions. Market Conduct Authority. They investigate complaints, monitoring insurer practices, ensuring compliance with state regulation, protecting consumer interests. Now, this should be bolded, highlighted, much bigger on this slide, all right? This is one of the most important things to understand. They like to ask this, and also it can help you if you understand this concept, find your way to the answers of other items, other things that could be brought up. The number one purpose and duty of the insurance director, superintendent, commissioner, whatever they're called for your state, their number one purpose is to protect the public. Okay, right here, they may also say consumer, protect consumers, those who are purchasing insurance policies, right? The insurance is confusing, right? It's a very confusing world. And unless somebody's studying for their exam, the average person buying policies does not know all the rules and laws and details and things like that. So there needs to be some type of regulatory group that is out there to keep an eye out for the general public when they are, working with insurance agents and insurance companies. So duties of the commissioner, when you're writing down, your flashcards and things like that, enforcing state insurance laws and improving forms and rates and issuing licenses. At the very top of this, put protect public or protect consumers. Okay. Sample question. The director can do all of the following except A, approve forms and rates, B, issue licenses, C, conduct investigations, or D, set insurance rates. Right? We said this a lot of times. They do not set insurance rates. They approve them. They do not set them. Okay, producer licensing basics. These are universal concepts. So who must be licensed? Anyone who sells, solicits, or negotiates life insurance, health insurance, or annuity contracts. And actually, this should just be all insurance. This includes producers, agents, representing insurers. There's a couple things from this box that we really want to go over. Okay, so I want you to understand sells, solicits, and negotiates. These three actions, whether you're doing one of them, all of them, some of them, this is transacting insurance. Transacting insurance. Or if you're doing this, you to transact insurance. Okay, so transact or transacting insurance. So it could be all of the following are considered transacting insurance except, and they'll throw in something else. Or if somebody is selling, soliciting, or negotiating insurance, what are they doing? They are transacting insurance. And in order to do that, what must they be? Licensed. Okay. When you go pass your exam, you can't start selling insurance policies that same day, right? You need to usually send in your application and background checked. We're going to get into this bullet point in a minute. And wait for the insurance commissioner or superintendent to issue your license. Okay. So you cannot sell, solicit, or negotiate insurance until you are licensed. Okay. So one more thing I want to hop back to that was important in this first box before we move on is producers or agents representing insurers. Another thing that you really need to understand is that agents represent insurers. They represent the insurance company that they work for. Now, while it is absolutely important and crucial and, fair trade practice and fiduciary responsibility to do right by your clients, your customers, consumers, you don't actually represent them. You represent the insurance company you are working for. So they could say, who does the agent represent in an insurance contract or in an insurance negotiation, et cetera? The agent is representing the insurance company that they work for. And who's out there protecting the public, protecting the consumers? The director, superintendent, etc. Okay, so in order to sell, solicit, or negotiate insurance, which we call transacting insurance, you must be licensed. All right, so application and background check. Some states require pre-licensing education, PLE. Okay, depending on what state you're in, you may actually be required to go through an approved insurance course. If you don't have one already and you need one, again, you can check that out on our website. But regardless, if your state requires you to go through a pre-licensing education course, you should, or watch videos, take notes, things like that. This is not common knowledge, right? These are not really an exam that you can go in and just pass. You really need to understand these concepts. Also, you need to know these so that you can be the best agent out there once you are licensed. But some states will require that you actually, some of them will even time it. There's a couple states that like you have to be logged on to your course for 40 whole hours, right? Some states like Illinois, you actually have to sit in a live class for so many hours. So it's important to know if your state requires PLE. One, so that you can complete it and get your certificate to go sit down for your exam. There's about 18 states that require it. But if you're in one of the other states, you don't need a certificate to go sit down, etc. But one, you need to know so that you can go take your exam. But two, so that you know how to answer any questions that come up about it. If your state does require pre-licensing education, they're normally going to ask you a couple questions about what those requirements are. And almost every state does do a background check and fingerprinting. Again, these are going to be found in your state-specific information. Okay. And then meet residency requirements. You normally need to be licensed in your home state before you can be licensed anywhere else, which jumps to our next one, resident versus non-resident license. So a resident license for your home state, if you are in Texas and you're going to take the Texas insurance exam, that would be your resident license. You live there, that's your home state. Now, if you want to sell insurance in another state, if you want to sell, solicit, or negotiate any form of transacting insurance in any other state, you must be licensed there. So although you're licensed in Texas, you cannot sell a policy to your aunt in Florida unless you get a non-resident license, right? There are so many agents that are licensed in multiple states, especially with life insurance and health insurance, okay? So it's very common that you're going to have an insurance license in multiple states, but generally you need to have your resident license for your home state, and then you can apply for non-resident licenses. A lot of states have reciprocity. So like if you're licensed in Texas and you go to apply for a license in another state, normally they're like, all right, you're good in Texas, you're good over here as well. Some states may require you to take the exam again. Some of them may require you to take a couple hours of some additional courses, things like that. So it just really depends state to state. But what's important here is knowing the difference between resident and non-resident. Okay, business entity and temporary license. Okay, business entities are agencies. That's all it is. A business entity is an agency in relation to the insurance exam. So an agency must also be licensed. So, when you're driving down the street and you see, State Farm agency. Agencies must have one person that they kind of say is like, the head of this insurance agency. That's usually whose name you see on the door, but usually inside there's multiple people that are licensed. And not only does John Smith need his own insurance license, he needs a business entity agency license as well. And then most states offer temporary licensing. Okay. So temporary licenses may be available in certain situations, usually for death of a producer or disability. Now, these are generally 180 days. Some states are 90 days. You need to look up your state specific. But because you cannot solicit, sell, or negotiate insurance without an insurance license, right? You must be licensed. Most states have something in place for a temporary license. So let's say John Smith has been an agent for 40 years and his wife was a school teacher and she retired. Doesn't do anything in insurance, but John passes away. Okay, so for 40 years he's been building this book of business. you can't even like add an auto policy. You can't change a car. You can't change a deductible without being licensed. So a lot of times states will offer a temporary license to keep the business flowing, to keep the business running while they figure things out. Again, this is usually in the event of death or disability. The timeline is going to vary by state. They are non-renewable. You cannot redo it. But let's say it's 180 days. John's wife's got 180 days to either go pass the licensing exam herself if she wants to take over the business, sell the agency, hire somebody else to step in that place, but it gives them some time to figure things out. Okay. Um, all timelines are going to vary by state. So generally a license term is good for 2 years, but you need to find out what yours is. So how long is an insurance license good for before you need to renew it? Again, it's usually 2 years, but some states vary. And then continuing education. Most states, if not all of them, require that you complete some continuing education during these 2 years. So need to find out what your continuing education hours are. Sometimes they also will have ethics hours on top of those. I mean, right here is 3 exam questions that you're most likely going to see. Actually, all of these. So make sure that you know these specific numbers for your state. How long is an insurance license good for? How many hours of continuing education must be completed? And within how many days does somebody have to report an address change or administrative actions? Generally 30 days, but again, you're going to want to find out your specific one. So if you move, you need to report it to the Department of Insurance within 30 days. They actually can impose fines and penalties for you not doing so. They need to be able to find you, right? What if they need to investigate or do a hearing? And then administrative actions, these aren't going to be like, hey, you got written up for being late to work too many times. These are going to be more serious things. You got let go because of fraud, things like that. You must report all of these things within. Again, this is generally 30 days. It could vary for your state. Check that out, please. But this is really important too, because this is how they're going to let you know, hey, your license is about to renew. Have you completed your X amount of continuing education requirements? So you want to keep that on file anyway. All right, so moving on. These are the things that we just went over. But again, these numbers are going to vary depending on your state. Okay, state specific. So we do have some workbooks that you can download on our website or at our school community. Where you can go ahead and just fill in the blanks for these sections for your state, or take a screenshot, print this out, pause, write this down, but fill it in with the correct numbers for your state. These are, like I said, some exam questions that they love, so you need to know what those are for your state. So a producer, an agent, those are interchangeable terms, is anyone who sells, solicits, or negotiates insurance. And what do we call that if somebody is selling, soliciting, or negotiating insurance? It is transacting insurance. And they are acting on behalf of the insurer, right? The agent represents the insurance company that they work for. Must complete application, background check, and fingerprints. There may be a PLE requirement. And then knowing the different types of state licenses, right? So resident versus non-resident, business entity, and temporary. You really want to know the number of days for the temporary license. Okay, so these will vary by state. Make sure that you are comfortable with these. Very likely you're going to see multiple questions from this slide, if not all of them. And those lead right into maintaining a license, like I was saying, right? That's why you want to have your address up to date and on file. You want to have your email address up to date and on file so that the Department of Insurance can get a hold of you. So in order to maintain your license, There are going to be different requirements depending on your state. Generally, once you pass this exam, if you keep up with your continuing education, which again, it's like 24 hours every 2 years generally, again, number could vary by state, you never, ever, ever have to sit down for this exam again, okay? Don't let your license lapse once you do it. You never, ever, ever have to go through this again as long as you keep up with your continuing education. On top of your CE requirements, you usually have to pay like a renewal fee. Again, find out exactly what that is for your state. License status renewal, typical every 2 years. Typically every 2 years. There are some states that are 3 years, some that are 1 year. Know what yours is. If your license lapses, that is your failure to renew on time. And if you need to get it reinstated, that is restoring a lapsed license, there's going to be different things you need to do. So make sure that you know what these are for your state. There are also some situations where there may be an inactive license if somebody is off to war or here. So temporary suspension. Or if something was violated and there's like a suspension on there until the hearing's over. So be comfortable with what these numbers are and rules and renewal rules, reinstatement rules, things like that. Example question, how often must producers complete continuing education? Again, this is going to vary by state, but I want you to be comfortable with how the questions could be asked, okay? So let's pretend that the answer is 2 years from this situation. So how often must producers complete continuing education? And it would be every 2 years. Again, depends on your state. Okay, moving on to producer authority. These are universal rules across the board. Understanding the different types of authority is critical for exam success and professional practice. So, you need to know the difference between express authority, implied authority, and apparent authority. Okay, express equals written. Express authority, explicit powers granted in writing through the agency contract. This includes specific actions the producer is authorized to perform. So these are producer authority, agent authority, what the agent has the authority to do. So express equals written. If the exam question specifically says something about it being in writing or the contract, they are talking about express authority. This is, where it's actually spelt out everything that the agent can and cannot do. Um, you know, in the contract, it says that they are able to issue binders for auto policies or, issue a home policy or issue a life insurance policy with such and such underwriter approval. Like it's the things that are actually written out in the agency contract. Okay, so that is express. Express equals written. Write that down, make a flashcard, just know that. So if you see in writing or in the contract, the answer is express authority. Okay, implied authority is powers reasonably necessary to carry out your express authority, right? It's not written down, but it's logically needed to do the job. So in order to sell that policy, right, based on your express authority, with your insurance company, you need to collect the premiums, right? That may not be written down specifically. Or, you want to advertise, put in your name for the local T-ball team on the back of their jerseys. You want to host a community event, trying to get people to come to your agency. Now, there may not be rules written down for all of this in your contract, but it is implied, right? It is implied that you can do these things in order to carry out your express authority. Okay. Apparent authority is authority that appears to exist. Okay. It's apparent. It appears that this agent can do this. It's based on the insurer's actions or the producer's position, even if not actually granted. Okay. So let's say somebody was terminated from their agency, but a billboard notice didn't go out. They didn't send a letter to everybody saying, hey, Frank is no longer with our insurance company. But he knocks on the door of an old client and says, "Hey, let's update your policy." And he's still wearing a shirt that, has that logo. They just talked to him a month ago. It's apparent that he still works for that company. Now, it doesn't necessarily mean that the person's doing something wrong when it comes to apparent authority. It's just that, those things like, um, let me think. Okay, if they collect the payment for the premium policy, right? So let's say, they're still licensed there and, they're sitting in the office. You walk into the office, the person at the front desk is able to pull up your policy and you hand them your check for the year. It's apparent. You walked into your insurance agency. This person's sitting there. They're wearing a company shirt. You gave them the check. It's apparent that they're going to do what they're supposed to do with it and deposit it into the correct account. If they deposit it into their personal account, they would be breaking fiduciary duty and all kinds of laws and things like that. But it was apparent to the customer that this person was allowed to do it. Okay. What's important to know here is vicarious liability. Even if that agent was let go, but still had a company shirts and showed up to somebody's house and collected a premium payment and kept it, the act of the agent is the responsibility of the insurance company they work for. Okay, so think of it as, um, if your kid throws a baseball through the neighbor's window and breaks it, as their parent, you're probably the one on the hook for having to pay for that window replacement, right? So the acts of the agent is the responsibility falls on behalf of the insurance company that they represent, right? Because the agent represents the insurer. Okay. Which is why they usually, you may have to go through a separate background check and things like that once you're getting appointed with a certain agency. Um, so key duties to the insurer, when as an agent, you represent the insurer. So you have duties to the insurer. Act within the scope of your license. If you have your property and casualty license, but not your life and health, you can't be out there selling life policies. Follow all company policies, report material information to the insurer, and handle premiums according to fiduciary standards. That is your financial responsibility. Fiduciary just means basically financial responsibility. Professional boundaries: cannot exceed granted authority, cannot make unauthorized promises, must act in good faith, and subject to regulatory oversight, right? The Department of Insurance is going to be looking over the agency and the agents. So doesn't mean that if an agent is out there just doing a bunch of wrong things that just the insurance company is going to get in trouble. No, they're responsible for the acts of their agent, but the agent is as well. They can get their license suspended, revoked, penalties and fines, all of that, which we will go over once we get into the unfair trade practices here shortly. So know what vicarious liability is, and that's that the acts of the agent fall on the insurer that they are appointed with. And then know the difference between express, implied, and apparent authority. Okay. They could also ask you, all of the following are types of agent authority except, and they will list these three: express, implied, apparent, and then some other option that is not there. So just make sure you're comfortable with these terms. Okay, fiduciary responsibility, nationwide rule. One of the most important universal concepts. Producers handle premiums in a trust capacity. This creates legal obligations that apply nationwide. Core principle: producers act as fiduciaries when handling client premiums. This means the money belongs to the client and the insurer, never the producer. Okay, so let's say you write a policy and your commission is going to be $400 out of it, and the customer writes you $1,000 check. You're going to get $400 commission for this policy. You don't get to take that $1,000 and pull your 400 out, right? You have to submit it to the insurance company, and then however they handle your commission payments, it needs to go that route. That money is not yours. A bunch of clients can't come in and make their premiums, and then you pay, the internet bill for your office. That money is never yours. It must go into a separate trust account. Okay, separate trust account. You cannot commingle funds. That is mixing client funds with personal funds. Usually, the company that you work for is going to have certain rules on how you need to deposit this money, how often you need to deposit this money. It's usually ASAP. You cannot hold on to those premiums for longer than reasonable. You cannot use client money for any personal reason. You cannot even mix the money together. That would be considered commingling. You must maintain a separate trust account. So any premium payments must go into this other account, and you must remit premiums promptly to insurers. They can ask a question saying, how quickly must an agent remit the premium payments to the insurance company? And the answer is promptly. Okay. They must keep accurate records on file and return any unearned premiums to clients. Example question. A producer who uses client premium money for personal expenses has violated A, express authority, B, apparent authority, C, fiduciary duty, or D, applied authority. Now, they kind of violated all of them, but what they're looking for here is fiduciary duty, right? We're not sure in which situation they did it. We don't know if they used that premium money while acting out something in their express authority or if it was apparent or applied. We don't really know. What they're looking for is what are we actually talking about? And that is messing with the money. And when we're talking about that, it's fiduciary. All right. If I had to say what is the most important slide of this entire presentation, it would probably be this one, along with the state specifics for getting a license, right? So how many hours of continuing education, how old you must be, how long your licensing term is. You're going to see a fair amount of questions from that slide. This is another one where I would expect to see a couple questions here, all right? So it's important that you understand these definitions. You're also really want to know the fines and penalties. These are going to vary from state to state. Some of them are as low as $1,000. Some of them are as high as $75,000. So please make sure that on top of knowing the definition and examples of these and knowing that they are prohibited, sometimes they're called unfair trade practices, sometimes they're called prohibited practices, unlawful practices, things like that. On top of knowing the definition, you need to know the fines and penalties specific to your state. So let's go through these. All right. Misrepresentation. Misrepresentation is making false or misleading statements about a policy's terms, benefits, or of an insurer's financial condition. Example, telling a client that their policy covers something that it doesn't. Okay. So this is misrepresenting something usually about yourself or the company that you work for. Saying things like this will cover anything that happens to your home, or you're going to make this much cash value in your life insurance policy. If it's not true and factual, if you're misrepresenting, making false or misleading. So misrepresentation, think of misleading statements. Now, again, this is usually these is for policy terms, benefits, or of an insurer's financial condition. So if the insurance company is about to become insolvent, that equals bankrupt, basically. They shouldn't be writing policies if they're not going to be able to pay out claims, okay? But we are going to, it's not on here. Okay, we're going to give you another one, defamation. I don't know why that's not on here. And I'm going to erase this part real quick. Give me 1 second. All right. Sorry about that. Okay, so defamation is making false or misleading statements about another agent agency or insurer with intent to harm their reputation. Okay? So, when you see false or misleading statements, it's not automatically misrepresentation. It could be defamation. All right, so we want to know the difference between these two. Again, misrepresentation is kind of lying about yourself, lying about the company you work for. Come over here. We're the best agency. This policy's got it all, right? You may be the best agent. Your policy may cover it all, right? But really, there's nothing that just covers everything, right? So it needs to be factual. Okay, so if you are misrepresenting yourself, these are usually going to be good things, right? You're lying to make yourself look good or your policy look good. Defamation is usually bad things, and these are normally about somebody else. Don't go over to so and so's agent. I heard he's a drunk. Don't go write your policy with this company. I hear they're going bankrupt, right? This is considered defamation. It is another highly tested unfair trade practice. Know the difference between the two and how to spot what the question is asking for so that you don't get caught up because those two are very similar. And then again, of course, know what the maximum fine and penalties are for your state for those. All right, false advertising is also a misleading statement or representation, things like that, but these are going to be in promotional materials. Okay, false advertising. The question will clearly state that they are talking about something that has to do with advertising. So, an example, advertising free insurance when premiums are actually required. Okay. So, it'll be very clear in the question that they're talking about advertising. And so, while that may be misrepresentation, we're clearly talking about an advertisement piece. So, it is false advertisement. Twisting. Again, we see the word misrepresenting. So, again, you need to make sure that you understand the full concept. I would make flashcards on all of these, write these down, go over your practice questions, things like that. So, twisting is when you're misrepresenting facts to convince someone to replace their existing coverage with new coverage that may not be in their best interest. So, twisting their arm, right? That's how I try to twisting their arm, telling them, come over to this policy, and just kind of lying about your policy, maybe putting them in a better spot when it does not. Now, it's not to say we can't steal clients from other agencies, right? That's what all insurance companies do. Come switch to Allstate, come switch to State Farm, come switch to Farmers. That's okay. But you need to be honest about whether or not your policy is going to put them in the same position or better, etc. Now, you can technically even be putting them in a policy that doesn't have the same benefits as long as you're honest and open about it. When we had an insurance agency, there were times where I sat down with clients and was like, we've got this, and that, but your current policy actually covers this and ours does not. Um, or, you're in a great spot where you're at. I can't beat that with that same deductible. And I've still had the people switch to us because they liked that I sat down with them and went over their policy, or they thought, you know what, that's actually not a coverage that I even needed on my policy. I'm fine to take that off. I'd like to come to you. You just want to make sure that, you have clear records showing that. And you don't want to be dishonest with people, telling them, if they send you their policy and they're like, here, switch me to you, and you take some things off or raise some deductibles, lower some coverage to try to match that price and get them to switch to you without letting them know, that would be misrepresenting it. That would be twisting. Okay. Churning, causing unnecessary policy replacement within the same company, primarily to generate new commissions for the producer. So this is like writing new policies that you don't need to just to get commission. So if somebody has a homeowner's policy under the husband, but you really need to hit your limits, you're going to write that exact same policy, but under the wife's name. That would be churning. You cannot do that. Okay. It's just churning people that are already in your book of business to try to make it look like you got more policies or to get a new commission. Coercion or intimidation. So this is using force, threats, or pressure to compel someone to purchase, lapse, or surrender insurance. Okay. You cannot be out there bullying and strong arming your customers. Okay. That would be coercion. Example, threatening to cancel other coverage unless they buy additional insurance. It's not how you want to be conducting your business anyway. Unfair discrimination. Okay, making distinctions between risks that are not based on valid underwriting factors or that violate state or federal law. Charging different rates based on race, religion, or national origin. Another thing they like to use here is people of the same class. Okay, so insurance is discriminatory in a way. They can charge a different rate for men instead of women. They can, a new driver, a brand new 16-year-old licensed driver is going to have a higher rate than somebody that's older, more experienced driver. They can do that, right? There's statistics behind that. Women have longer life expectancies than men. There are statistics behind that, right? But in order to those are people of different classes, right? So men versus women, those are different rate classes. Young drivers versus experienced drivers, those are different rate classes. But charging two young drivers something differently because of their race or religion or things like that would be unfair discrimination. So they can try to trip you up here and say, all of the following are prohibited practices except, and they can say charging different rates of people that are in different classes. No, you're allowed to do that. So make sure how this question is worded. And then rebating, okay? They love to, this is a highly tested concept, okay? So rebating is, if you see the word inducement or induce, it basically means bribe. This is bribing somebody to come get a policy with you. Offering anything of value not specified in the policy as an inducement to purchase insurance. This is prohibited in nearly all states. An example, promising to share commissions with the client. Let's say you want to sign your buddy up and you're like, hey, come write your policy with us. I'll pay your first month premium. That would be something of value. That would be rebating. That would be an inducement. That would be a bribe. It is not allowed. There are certain limits per state, and it's usually like $10 or $25. So make sure that you know what that limit is. But still, that can't be used to get them to switch to you. So when I had an agency, we used to give out $10 Visa gift cards just for getting a quote, right? So come on over, check out our booth, when we would do trade shows or, come into the policy this week and get a quote and we'll give you a $10 gift card. So even if as long as they sat down for the quote, no matter if they didn't sign the policy with us, they were getting that $10 gift card. It is a fine line. We need to be very careful. We kept very good records on it. And the insurance company I worked for that I represented actually issued these gift cards. It was part of a nationwide promotion they were doing, so it was allowed. But I couldn't have then said, all right, if you switch to me, I'll give you 3 gift cards. That would be bribing. That would be rebating. All right, it's called rebating. It is a fine line, and it is the one that is most commonly violated. All right, agents will say, I'll share my commission with you if you switch this policy with me. Or sharing it with, the secretary at the front desk who's not licensed, getting her to bring her family members in, and you swear if she sends them to you, you'll share your commission with them. That is not allowed. You cannot share commissions with anybody that is not licensed. If the question does not clearly state that Brittany at the front desk is licensed, do not assume that they are. Also, in the test questions, they will make it very clear that this is of a high value. If they don't actually write, $100 or, first month premium, even if that first month premium was $8, you can't do it, right? It's not how it works, okay? But they'll usually use something that's of high value. If they don't state a dollar amount, it'll be, floor seats to a sold out concert or a sporting event, things that you can tell are very of high value. Okay. Now you can do promotions for people that are already within your company. My insurance agent actually is always giving out raffles for tickets to events and things like that. And that's for us to refer people, whether or not they switch, just, speaking highly about our agent. If people go over and get a quote, they put our name into a raffle, like that's allowed. So just be clear on whether or not this is a bribe, if we're offering, things that are not specified in the policy. If you see things that say like the word inducement or bribing, then you know that the answer is rebating. Again, check this section out for sure. the rebating, because that's the only one in your state specific, could have some different dollar amounts. Usually it's no higher than 25 if it's allowed at all. And then please make sure that you know the fines and penalties, because they could say in your state, what is the highest penalty per violation of rebating? What is maximum fines for misrepresentation? You need to know these, all right? We do go over these in our state-specific videos, so please check those out as well. There are also claims and consumer protections and laws and rules in place, okay? And you're going to need to know the timelines, the days for your state, okay? So insurers must acknowledge receipt of claim within a reasonable time, typically 15 to 30 days, depending on your state. So if somebody calls in and says, hey, I have to submit a claim, or they've submitted a claim online, or however it's done for this agency and this policy, the insurance company has a set amount of days that they must acknowledge the claim. You need to know what that day amount is. Then they must promptly investigate the claim and cannot unreasonably delay the claims process. You need to know how many days, okay? How many days do we have to acknowledge a claim? How many days do we have to investigate a claim? And how many days do we have to pay? They must pay promptly. And some states, the answer is promptly. Now, we're generally going to see 30 days or 60 days or 15 days, but there are some states where the answer just says promptly. So in your reading, if you are only seeing that claims must be paid promptly and you're not seeing any other dollars or days amounts, number of days, you're only seeing promptly, that is your answer. Promptly is a time frame in the insurance world. And then they must provide in writing what their outcome is. Are we approving this claim? Are we denying this claim? Do we need more information? Must be provided in writing, and again, within how many days. So make sure that you are comfortable with the claims and consumer protections for your state. Example question. Okay, remember your state will have specific timeframes. Learn those numbers for your exam. Example question. What must an insurer provide when denying a claim? Oral explanation, written explanation with reasons, no exclamation required, or explanation only if requested. And right here it would be written. When in doubt, it needs to be in writing. And when in doubt, 30 days, but I didn't say that. Make sure that you know these for your state. Okay? All right, that is the most tested areas that you'll see on state laws and regulations that are general or common to all lines, depending on if you're taking life and health. Accident annuity will determine what we jump into next, or if you're taking property and casualty, etc. We're going to hop into whichever one of those are next. And if you need to see the others, or if you want to check your state specifics and see if we have a video up on those yet, please check out our other videos. There are other concepts that are gone over in state laws and regulations that are common to all lines, but these are the most common and the most important parts of your exam. So if you go along with this video to your state specifics and know those numbers and timelines and frames and definitions, you'll be in a super solid spot to pass the state law and regulations section. Again, we've got workbooks and videos and fill in the blank workbooks that may be specific to your state. So definitely check those out on our website, fastpassuniversity.co, that is .co. And we will jump into your section 2 right now. All right, so how state regulation works. Every state has a Department of Insurance, and there is somebody that is either elected or appointed by the governor to kind of head the department, okay? And depending on what state you're in, that person may be titled something a little different. So most common, we're going to see commissioner, director, or superintendent. There are some states that call it something different. Chief officer, we'll see down here. That is for Florida, actually. All right, so now we are going to focus on state laws and regulations that are specific to life, health, and annuity. These chapters can be called something different depending on what state you're in. Could be life and health, life, health, and accident, life and annuity and health. We're encompassing the same thing, all right? So again, we're going to go over kind of that national level core concepts for the state law regulations. You're going to have some that are very specific to your state, certain programs that are just for your state regarding life policies or health policies, etc. So make sure you look at those or check out if we have a video for your state yet. We also have some courses on our website. But we're going to kind of go over the more focused areas on the exam that you may see here. So, all right. So replacements, okay? Replacements for life and annuity policies are one of the highest tested things that you'll probably see when it comes to the regulations for this section. So you want to make sure that you look over your certain timelines, etc. But replacement regulations are strict, right? So this is when somebody is canceling or letting a policy lapse, a life policy or an annuity policy, and signing up a policy with you. So you're replacing their life insurance policy or replacing their annuity policy. Replacement regulations protect consumers for unsuitable policy changes. The concepts are consistent, but states have different specific requirements, okay? So some of these are pretty much standard across the board, right? So you must provide a notice regarding replacement to the client. So you need to provide a notice of replacement, okay? And it has to be in writing, and it has to be before you replace their policy, all right? So before collecting that first premium, before putting that policy in place, they need to have a notice of replacement. The notice must be signed by both the agent and the applicant. Sometimes they'll ask questions like, an agent is submitting a replacement policy, but notice once they left the office or once they left the client's home, the client did not sign it. Is it okay to submit it with just the agent signature? Or can they sign for the applicant? No, not by any means. They need to go back and get that signature from the applicant. Now, a lot of these things are done electronically, but you'll see that when it comes to the insurance exam, they're still worded in the way like you are out there as a field agent going, to customers' homes. And there still are a lot of people that do that. All right. They must maintain replacement records for, now, generally it's 3 years, but this is going to vary by state, okay? So you're going to want to find out for sure how long do they need to keep replacement records for replacement policies, okay? And they must provide a side-by-side comparison of existing policy versus the proposed policy when comparing and negotiating it with the customer. And they must ensure that their replacement is in the client's best interest, okay? We do not want to be replacing their policy and putting them in a worse situation. Now, it could be that they're letting that policy go. Maybe they can't afford that one anymore. So it's not that yours has to be better coverage, this, or that. It needs to make sense for the client, okay? It needs to be suitable. It needs to be in their best interest. The replacing insurer duties, so the replacing insurance company's duties, they must notify the existing insurer within 5 business days. Now, again, this number could vary, but that's pretty typical across the board. And they must provide a free look period. It's typically going to be 30 days for replacement, but again, check your state. So they must have the option to cancel the policy and get their money back. It's usually 30 days for replacement policies, right? 30 days to change their mind. That's what a free look period is. Free look is changing their mind. They must maintain replacement records, again, find out what that number is, and monitor patterns of replacement and ensure suitability of replacement. So if they've just got one agent out there that all he's doing is replacing policies left and right, they may want to look into it. Suitability is a huge part of life insurance and annuities. Example question, how long must replacement records typically be maintained? In this instance, the answer would be C, 3 years. Again, these are going to be state specific, but I want you to get comfortable with how the questions may be worded. Suitability. So we were just speaking on this. Suitability is a huge part when it comes to life insurance and annuities. And when you get into securities, there's entire chapters just on suitability rules. Don't worry, you're not learning securities. I meant if you were to go on and work on getting your securities licenses as well. Okay. Annuity suitability is regulated nationwide with all states adopting similar standards based on the NAIC models. So saying that, there is this nationwide kind of regulation and that the states must follow at least that. They can make some, changes that as they want to for their state, on top of them, right? But they have to at least meet these standards, right? These similar standards across the board. Now, if you're like, shoot, I don't remember what's going on with annuities or what those policies are, we're not going to get into specific policy types or things like that right now. We're just going over the state laws and regulations. In my opinion, laws and regulations should be the last thing that you study. You should have a very solid understanding on the policy types before you get into the laws and regulations, but you can check out our other videos or courses or things like that. We're going to constantly be dropping new content, but if there isn't a video out on something that you want us to go over, just drop that in the comments and we will get working on that. All right. So annuities, right? There are some suitability requirements. Information gathering. Must collect information about clients' financial status, tax status, investment objectives, risk tolerance, and existing assets and liquidity needs. So when you are about to write somebody a policy, whether it's their very first one, and it's annuities or life, or you're replacing them, you need to do a needs analysis. A lot of times it's called a suitability analysis. Now, back in the day, there was a form that you filled it out and tallied up and came to these answers. A lot of times there is going to be programs and software for the company that you're working for that helps you determine what a customer's investment objectives are and risk tolerance are. So, but you do need to gather the information and come to this answer, right? So it's going to usually be a part before you're even doing the application, things like that. You're going to kind of go through a needs analysis, suitability analysis. You need to get their financial status and income, their tax status, their investment objectives, risk tolerance, and existing assets and liquidity needs. How soon are they going to want to be able to access the cash in this policy, right? If you're writing a policy that has, a 10-year thing in place where, they will actually take a penalty if they were to withdraw cash within the first 10 years, but this client wants to access this cash next year, that policy wouldn't be suitable for them. So on top of gathering this info so that you know what's best for your client, these are things that you need to keep on file. These are records that need to be maintained so that you can explain why you put somebody into a policy, right? So maybe they do all of this and their risk tolerance is a little low, but they want to take a bit more of a risk. You just want to have all of those things in writing. Best interest standard must act in the client's best interest. Not fiduciary duty. That's a different standard. Okay. So fiduciary duty is when we're actually dealing with their money. This is just in general that we're doing what's in the best interest of the client. Consider client's needs over producer compensation and document recommendation rationale. Why are you recommending this policy? Why are you putting them in this policy? How does that make sense in correlation with the information you gathered, right? At the end of the day, you're going to get much, much further in this industry by doing what's right by your client. Okay. Insurer oversight, supervision of producer recommendations, review of annuity transactions, training and compliance programs, and monitoring for unsuitable sales. So insurer, that's the company you work for, right? Insurer is insurance company. So they need to be supervising these. A lot of times, if you're going to be working for a company where you are writing annuities, you're going to have a lot of training, a lot of compliance, a lot of check-ins, right? Right here, training requirements. So there is a one-time annuity training required at minimum. Okay, so a lot of times after you get your life and health license, you also need to go through an annuity training. That's going to vary by state, but the hours vary by state, typically 4 to 8 hours. Some states don't have this, okay? So if you're not seeing anything about it in your content outline or in your coursework or anything, that your state may not have this. But a lot of states do have at least a one-time annuity training course. Must be completed before selling annuities, and ongoing continuing education may be required. This is going to vary by state specific. Okay. A lot of times, kind of questions you're going to see about this is what information is gathered for collecting information to find out if something's suitable. When writing annuities, you must act in, the best interest standard, must act in the best interest of the client, things like that. Okay, federal laws affecting life and health. These federal laws override state regulations and apply nationwide. You may have some state level companies, organizations, things like that, or laws, but these are federal across the board. Okay. All right. So HIPAA, Health Insurance Portability and Accountability Act. This protects medical information privacy, ensures portability of health coverage, limits pre-existing condition exclusions, and requires special enrollment periods. So HIPAA is kind of like the privacy of customers' information. A lot of times that they will ask, which one of these organizations does this, and they'll start explaining some of these bullet points. So you need to know the difference. So HIPAA protects medical information, ensures portability of health coverage, limits pre-existing exclusions, and does require special enrollment periods. Most likely what you're going to see is that they're talking about protecting the medical information privacy, but they could ask you a all accept. So be comfortable with what each of these entail, make some flashcards, etc. So they could say HIPAA does all of the following except, and throw something in there to confuse you. ACA, the Affordable Care Act, okay? This establishes essential health benefits. There are 10 essential health benefits that must be covered when it comes to the Affordable Care Act. So you're going to want to go over what those 10 essential health benefits are for the Affordable Care Act. It prohibits denials for pre-existing conditions, and it creates health insurance marketplaces. That's, going online to healthinsurance.gov. It's where you can go buy insurance in the marketplace, right? And there's certain enrollment periods, there's certain exclusions or grace periods where you may be able to enroll outside of those enrollment periods, things like that. And it does require minimum coverage standards. So every policy, whether you're getting the lowest policy or the top dog platinum policy, they all must have a minimum of coverage standards, and those are those 10 essential benefits. So make sure you are comfortable with what those are, because they could ask you. The Affordable Care Act includes all of the following except, and throw something in there. We do go over these in depth on another video, as well as in the state-specific ones if we have your state-specific video up already. But again, if anything, 1 or 2 questions on this, all right? Just make sure that you know what it is. A lot of big things is the pre-existing conditions. Now, HIPAA does limit pre-existing conditions. If the question is only asking about pre-existing conditions, we're going to lean more towards the Affordable Care Act. It's more popularly popularly known to be a part of the ACA. That's what put this in place, okay? FCRA, Fair Credit Reporting Act. They love to ask a question on this. So what is the Fair Credit Reporting Act? It regulates the use of consumer credit information. It requires disclosure of credit checks. It gives consumers the right to dispute errors and applies to underwriting and claims. So a lot of times they'll say, which of these regulates consumer credit information or gives consumers the right to dispute errors on their credit report? It's going to be the FCRA, Fair Credit Reporting Act. Do not call, can spam. They could say the can spam law is also called the do not call, or the do not call is also called the can spam. So just know that these are interchangeable. And that is what created the do not call registry. So that limits telemarketing. The Can Spam Act regulates email marketing. So they do go hand in hand, but the do not call is for actual phone calls. The Can Spam Act is for email marketing. There are exceptions for existing business relationships, and it does require opt-out mechanisms. If you notice, every email that you get from anywhere has to have the option for you to opt out. If it doesn't, they're actually violating the Can Spam Act and can get in a lot of trouble. Okay. Example question: which law protects the privacy of health information? ACA, HIP, or ACA, HIPAA, FCRA, or Can Spam? Right? And this is going to be HIPAA, so privacy of health information. So that is the in-depthness that we are going to go for life, health, and annuity. Those are going to be the areas that are most commonly seen on the exam, right? You are going to have some specific ones. If you are in a state and it says, you know, the Ohio something something, or the Illinois this or that, something that is specific to your state, that is a law regarding life, health, annuity, things like that. Just think about it. If a state has its own law, they're going to want you to know it, right? So there's usually only a couple, and some states don't have any. But if you see something that actually has the name of the state in the title of the law, pay attention to those. Just think, if you wrote this law, you'd probably want to throw a question in there on it, right? But honestly, if you are comfortable with that first section that we did, the general state laws and regulations common to all lines, you're going to be in a good spot. It does depend on what state you're in. Some states test very heavily on just their state specific parts to these sections. So, just make sure you're comfortable with it. Don't stress on it too much. You've got this. And if we don't already have a state specific video for your state, drop a comment below and we will get one made for you. These are just some summary exam must-knows. We're also going to then show you a summary table, and we also have some practice questions. So don't leave just yet. So going back to the beginning, regulatory authority. You need to know what your head of the Department of Insurance is. Who is it that, runs that office? Is it the commissioner, director, superintendent? Is it called something else? What are their powers and duties? Remember, we talked about they can enforce laws, conduct hearings, approve rates, right? But they don't set them. The title varies by state. Make sure that you know your licensing requirements for your state. They love to ask questions on that section. Like I said, you usually will get several questions on that section. So how long is the license good for? How many hours of continuing education? How old must you be? It's usually 18, but again, just make sure you check. Do you have pre-licensing education requirements? What are those? Things like that. Make sure you know the difference between express, implied, and apparent authority. Understand what fiduciary means, no commingling of funds. Make sure you're always acting in the client's best interest. Make sure that you know all of the prohibited practices. Okay, very likely you're going to see several questions from that section. Here's just a couple right here, but really make sure you're comfortable with those. Make sure that you know the consumer protections. What kind of things are in place for replacement notices and free look periods? These are going to vary, for certain life insurance policies, etc. They love to ask those days, right? They love to ask free look periods, and they usually vary when it's a regular policy to a policy written for senior citizens and such. Make sure you know your claim handling timelines and days and your suitability standards. Get comfortable with these federal compliances, and you should be in a good spot. Here's kind of a summary recap table. You can pause it. You can also go take a look at our website, and we've got the workbooks that you can download or fill in. And we also have those specific to your state. So just go check those out. And let's do this practice quiz now. All right. Now, again, remember that if there are specific numbers on here, these are just for an example so you can get comfortable with how the test questions are worded. You need to find out your state specifics, okay? All right, number 1, the state official who regulates insurance may be called a commissioner, director, or administrator, superintendent, controller, or secretary. Now, you wouldn't see a question just like this on your exam. It would more be like the state official who regulates insurance in Texas or Florida or Michigan. It's going to say, specifically your state, and then you need to know what that person is called for your state. Okay. Number 2, a producer who uses client premium money for personal expenses has violated which prohibited practice? Express authority, fiduciary duty, implied authority, or apparent authority. Number 3, misrepresentation facts to induce someone to replace existing insurance is called churning, twisting, rebating, or coercion. Okay. Now, there's a trick here, right? I said if you see the word induce, you're normally going to think rebating, right? But right here, replace existing insurance. So this isn't just regular rebating. This jumps to, I'm going to give you the answer to this one right now, twisting, right? Because we are trying to induce them to replace their existing insurance policy. And actually, we'll just go back and do each one. So that first one, the other option was superintendent. But again, question 1 will be asked differently. A producer who uses client premium money for personal expenses has violated what, right? If you're messing with the money, you're messing with fiduciary duty. Number 3 was twisting. All right, so number 4, the typical continuing education requirement for producers is, again, this one's just going to be, 24 to 30 hours every 2 years. They're not going to ask you what's the typical, right? They want to know your state specific. So you need to know this number, all right? Know this. Which federal law protects the privacy of health information? We just went over this. That would be HIPAA. Number 6, the standard free look period for replacement policies is typically, in this situation, it's 30 days. Again, know your state specific. All right, number 7, powers reasonably necessary to carry out express authority are called, right? So express is in writing. What type of authority is there? It may not necessarily be in writing, but it helps you carry out that express written authority. It is implied. All right. Offering to share commission with a client is an example of what? That would be rebating. And for annuity sales, producers must gather information about a client's A, financial status only, B, investment objectives only, C, financial status, tax status, investment objectives, and risk tolerance, or D, age and income only. It's going to be C, right? Usually also, when in doubt, pick the most thorough answer. And replacement records must typically be maintained for 3 years. Again, you need to know your state specific. Some states are 5 years, some are less. So just make sure that you know what your numbers are. This is the answer key, but we did just go over those. But I'll leave that up for a second. And some good luck and study tips. Again, you have gotten through one of the most difficult chapters, the state laws and regulations. Hopefully we help make some sense of it. Don't stress yourself out. You've got this. Make sure that you focus on numbers, timelines, fines, penalties. They love numbers, right? They're going to make sure that you know which number relates to that specific law. So focus on challenging concepts. If you're having a hard time, with the implied authority versus parent, like make sure that you're comfortable with it. Memorize key definitions. Understand the why. Don't just memorize rules. Like try to make sense of it, right? A replacement policy is a little bit more tricky than a regular policy. So it makes sense that the free look period may be a little bit longer than others. Utilize practice questions, but not to the point of memorization. You don't want to just keep taking the same quiz over with the same 10, 15 questions or same exams. Make sure that you are getting those from a nice mixed pool. We do have some of those available as well. But you want to make sure you understand the concepts behind it, not memorizing, because the way the questions are going to be worded on your state exam are going to be different than anywhere you can possibly find them online. All right. Manage your time wisely. Make sure that, you don't dwell on one question too long. If you're unsure, you could mark it and return later. I like to go with your first gut instinct and move on. And prioritize self-care, right? Make sure you're getting plenty of rest the night before your exam. Eat a well-balanced breakfast before you go. A clear mind performs best. You've prepared diligently. Now trust yourself. So we wish you the very best on your insurance exam, and keep an eye out or go find your state-specific state law and regulation video or check out any of our other videos as well.